All right, let's talk about something that's probably been bugging you. We're going to dive into why your insurance policy seems to be shrinking. I mean, it feels like every year the cost just keeps climbing, right? But what are you actually getting for that money?
Yeah, it's such a frustrating feeling, isn't it? You're paying more and more, you're a loyal customer, you do everything right, but the actual protection you thought you had, it just feels less solid. So why exactly are you getting less when you're paying more? It's a question a lot of us are asking.
Okay, so your first thought is probably just greed, right? And look, that might be part of the story, but it's not the whole story. The real answer is actually way more complex and honestly pretty fascinating. It points to this huge shift that's happening just under the surface of the entire industry. What we're really talking about here is a fundamental change in how risk itself works. The very rulebook the insurance industry uses to calculate and manage risk is being rewritten. And you guessed it, that change has a direct impact on that policy that's supposed to have your back.
Okay, Section 1, your shrinking policy, or as I like to call it, the problem in your pocket. Let's start with the stuff you can actually see and feel in your policy documents, even if you haven't realized it's happening yet. First up, and this one's pretty obvious, you're just getting less coverage. Think of it like this. That big protective umbrella that used to cover your entire house, well, now it feels like it only covers the living room. Stuff that used to be totally standard is suddenly an extra you have to pay more for. And then you've got more exclusions. These are the sneaky little lines in the fine print that say what is explicitly not covered. They're basically creating these little trapdoors in your safety net, and you probably won't even know they're there until you fall right through one. And of course, higher deductibles. You know what I'm talking about? That chunk of money you have to cough up out of your own pocket before the insurance company even starts to pay a dime. It just seems to go up and up and up.
But here's the really scary part. You don't notice any of this is happening. There's no big flashing warning light. These changes are silent, and you only discover them at the absolute worst possible time, when you actually need to file a claim.
So that brings us to the big why. Why is all this happening? It all comes down to a massive change in the basic promise of insurance. We're seeing this core shift, moving away from a world of risk transfer to a new reality of risk sharing.
You know, for decades, insurance followed a really simple promise. It was like a handshake deal. You pay your premium, and the insurance company takes on the heavy risk of a huge, catastrophic loss. That was the deal. But quietly, that promise has been changing. It's not quite the deal we're getting anymore. This really breaks it down perfectly. On the one hand, you had the old model, risk transfer. It was simple. You paid them to take the risk completely off your hands. Done. But now we're in the risk-sharing model. Insurers are basically saying, hey, look, we'll still cover the massive, once-in-a-lifetime disasters, but for all the smaller, more common stuff, you, the policyholder, are going to have to shoulder a bigger piece of that burden.
So why the big shift? It boils down to one simple idea. Coverage shrinks when predictability disappears. Think about it. When crazy weather events, cyber attacks, and lawsuits become harder and harder to predict, the cost of insuring against them just goes through the roof. For the insurance companies, this isn't about punishing you, it's a survival tactic.
All right, so let's get into the nitty-gritty. How do insurers actually shift that risk back onto you? What are the hidden tactics they're using? Well, they've got a whole toolkit they can pull from.
Okay, these are the four big ones. We already talked about higher deductibles. Then you've got coinsurance, which means you're on the hook for a percentage of the total loss. Sublimits are really sneaky. They put a tiny little cap on certain types of damage. So your policy might say it covers you for, say, 300 grand, but the sublimit for a basement flood might only be 10,000 bucks. And then there are percentage-based losses, often for stuff like wind or hail damage. This means your deductible isn't a flat number, it's a percentage of your home's total value. Yeah, that can add up to a huge amount of money fast.
But there's another tool in their kit that's even harder to spot. Instead of just tinkering with the numbers you pay out of pocket, they just remove a piece of the puzzle. They take a whole type of coverage out of the policy completely.
And here's what that looks like in the real world. Things like certain kinds of water damage, cyber events, business interruption, stuff that used to be standard is now just gone. It's excluded. So your policy might look the same on the first page, but believe me, it acts totally different when you actually need it to work. And this really hits the nail on the head. Coverage gaps don't announce themselves. They don't send you an email. They only pop up when something breaks. It's the definition of too little, too late. Okay, so moving on. It's not just about decisions being made inside the insurance companies.
The whole industry is being squeezed by these massive, invisible forces that are totally beyond their control.
And one of the biggest forces is something called social inflation. Now, this has nothing to do with the price of gas or groceries. It's all about how societal trends are making insurance claims way, way more expensive. We're talking about juries handing out these massive awards and lawsuits, and just the cost of going to court in the first place is skyrocketing.
I mean, just look at this chart. It shows you everything you need to know. The cost of claims in the past versus now, it's just a world of difference. So if you're an insurer and you see that trend line going straight up, what are you going to do? Your only logical move is to limit your exposure. And how do you do that? You shrink what you cover.
All right, so let's bring this all home. What is your new reality? What does all this actually mean for you right now?
Well, here it is. From now on, expect insurance to be sold less like an all-you-can-eat buffet and more like an a la carte menu. You're going to see a lot more optional endorsements. Those are add-ons for stuff that used to be baked right in. Those old all-risk policies, they're becoming a thing of the past. And what that really means is that more and more of the responsibility is shifting onto your shoulders to know exactly what's in your policy.
And if you remember one thing from this whole explainer, let it be this. Insurance doesn't adjust to people. It adjusts to pressure. The reason these changes feel so unfair is because they're not personal. It has nothing to do with you or how long you've been a customer. It's just a cold, calculated statistical reaction to all the pressure on the system.
So, I'll leave you with this question. Now that you see what's happening, is your policy ready for the pressure? Is it really built for the world we live in today? It's probably worth taking a look.